What if I told you that the world's most valuable company, worth nearly $4.5 trillion, might be building the most elaborate house of cards in corporate history? And what if this house of cards could come crashing down faster than anyone expects? Well, friends, today we are diving deep into NVIDIA's latest $100 billion deal with OpenAI and why it reveals a potentially catastrophic emerging business model that could devastate shareholders when the music stops. But first, hit that subscribe button because we are about to expose something that mainstream financial media is completely missing. Last Monday, NVIDIA and OpenAI announced what Jensen Huang called a monumental $100 billion partnership. The financial press went wild. NVIDIA's stock jumped $170 billion in market cap overnight. Everyone is calling it a massive win. But here is what they are not telling you. The deal perfectly illustrates a dangerous pattern that NVIDIA has been getting into for years. A pattern where NVIDIA has become both the supplier and the customer, where it's investing billions into companies and then those same companies are spending those billions right back on NVIDIA products. It's financial alchemy at its best, and it might be about to blow up spectacularly. Let me show you what's exactly happening, why it's so dangerous, and what it means for anyone holding NVIDIA stock. First, let's break down this OpenAI deal because the details are absolutely wild. According to CNBC's exclusive reporting, this wasn't just any ordinary business negotiation. Sam Altman had a literal deadline. He was flying to Texas to make an announcement, and Jensen Huang wanted in on the action. Two of the most powerful people in tech conducting billion-dollar negotiations through hurried negotiations, late-night calls, and last-minute contract tweaks. No bankers involved, just two CEOs reshaping the entire AI industry over phone calls. The structure is fascinating and terrifying. NVIDIA invests $10 billion at a time into OpenAI while simultaneously supplying all the cutting-edge processors for OpenAI's massive data center build-out. But here's the kicker. OpenAI only informed Microsoft, that principal shareholder, one day before signing. Think about that, a $100 billion deal that could reshape cloud computing, and Microsoft gets 24-hour notice. This wasn't careful corporate planning. This was two executives making backroom deals that could affect millions of investors. But the OpenAI deal isn't unique. It's part of a pattern that should terrify every NVIDIA investor. Let me tell you about CoreWeave, a company that most people have never heard of, but perfectly illustrates what's really going on. CoreWeave went public in March with NVIDIA's help. The IPO was so poorly received, it was undersubscribed. They had to lower the price. NVIDIA stepped in with a massive stock purchase just to get the company public. Fast forward to today, NVIDIA owns $3 billion worth of CoreWeave stock, making them a major shareholder. But it gets worse. Just last month, NVIDIA signed a $6.3 billion deal guaranteeing to repurchase CoreWeave's excess capacity through 2032. Let me repeat that. NVIDIA is both a major investor in CoreWeave and contractually obligated to buy their services for the next 8 years. Do you see what's happening? NVIDIA invests billions into CoreWeave. CoreWeave uses the money to buy NVIDIA hardware. Then NVIDIA guarantees to purchase CoreWeave's unused capacity. It's like lending to someone the money that you have to buy your products, then promising to buy anything they can't sell to others. It's financial engineering masquerading as organic growth. And it doesn't stop there. NVIDIA just invested $700 million in UK startup Nscale. Guess what Nscale does? Data centers powered by NVIDIA chips. $5 billion into Intel for joint chip development, investment in dozens of AI startups that all happen to be massive NVIDIA customers. Are you starting to see the pattern? This is what I call NVIDIA's circular revenue amplification model, and it's creating one of the most dangerous house of cards in corporate history. Here is how it works. Layer 1, NVIDIA invests billions into AI infrastructure companies. Layer 2, these companies use NVIDIA's investment money to purchase NVIDIA hardware. Layer 3, NVIDIA guarantees to buy excess capacity from these same companies. And Layer 4, this creates artificial demand signals that inflate NVIDIA's revenue and stock price. Layer 5, higher stock prices allow NVIDIA to make more investments, repeating the cycle. When everything is going up, this looks like genius. NVIDIA appears to have insatiable demand, growing revenue, and a portfolio of valuable investment because, come to think of it, the second wave after hardware is going to be the data center. Wall Street loves it. But that's a critical flaw in this model that becomes obvious the moment you start to think about it. What happens when the cycle reverses? Let me paint a picture for you as to how this could all collapse in a matter of months if that happens. Imagine it's 12 months from now. Interest rates are still high, venture capital has dried up, and the AI hype has cooled. And it has cooled off just enough that companies start questioning their massive compute spending. And here's where the domino effect begins. Domino 1. OpenAI's revenue growth slows. They cut back on data center expansion. Domino 2, CoreWeave, already deeply unprofitable according to their filings, can't fill their capacity. Remember, they are burning cash on massive debt payments from their build-outs. Domino 3, NVIDIA's portfolio companies start struggling simultaneously, the same market forces hitting all of them at once. Domino 4, NVIDIA's investment portfolio takes massive losses, billions in write-downs. Domino 5, but here's the killer. NVIDIA is contractually obligated to keep buying capacity from the companies that are failing. That 6.3 billion CoreWeave commitment doesn't disappear. Hardware sales collapse. This is Domino 6. Hardware sales collapse as the same companies that were buying billions in chips suddenly can't afford them. The result? NVIDIA gets hit 3 ways simultaneously. Investment losses on their portfolio, massive drops in hardware sales, forced purchases of unused capacity from falling companies. All 3 factors start to crunch in. Traditional companies might see their revenues decline gradually, but NVIDIA's circular model means when it breaks, everything breaks at once. This isn't speculation, it's basic economics. When you create artificial demand through financial engineering, you also create artificial risk. Now, I'm not saying that the collapse is inevitable or imminent. NVIDIA's technology leadership is absolutely real, and AI demand may continue growing for years. In fact, I'm invested in NVIDIA. But there are warning signs that smart investors should be watching with this growing trend of NVIDIA's investment strategy. Warning sign number 1, revenue concentration. When your biggest consumers are also your investment portfolio, you have created a concentration risk on steroids. Warning sign number 2, debt levels at portfolio companies. CoreWeave is already struggling with debt repayments, and they are supposed to be a success story. Warning sign number 3, timing pressure. These deals are getting done with last-minute negotiations and 24-hour notices to key partners. That's not careful planning. Warning sign number 4, valuation multiples. NVIDIA is trading over 13 times forward revenue. There is no room for error at these prices. The biggest warning sign? Nobody in mainstream finance media is talking about this risk. When someone or everyone is focused on the upside, that's usually when you should be worried about the downside. So what does this mean if you own NVIDIA stock or you're thinking about buying? First, understand what you're actually buying. You're not just buying a semiconductor company with great technology. You're buying a complex web of circular instruments and contractual obligations that amplify both gains and losses. In a traditional business model, if your demand for your core product drops 20%, your revenue drops roughly 20%. But in NVIDIA's emerging circular model, a 20% drop in AI demand could trigger investment losses, hardware sales declines, and forced capacity purchases simultaneously. The mathematics of downside risk are completely different. This doesn't mean NVIDIA is a bad company or that you should panic sell. That technology leadership in AI chips is absolutely genuine and valuable. But it does seem that you need to think differently about position sizing and risk management as NVIDIA starts more and more getting into these kind of investments. If you own NVIDIA, consider it as a high volatility holding than traditional value metrics suggest. Don't let it become an oversized portion of your portfolio. Have a plan for how you would handle a rapid decline. Watch the health of their portfolio companies, not just their chip sales. If you're thinking of buying, understand that you're buying complexity, not just growth. Consider dollar cost averaging rather than lump sum purchases. Be prepared for potentially extreme price swings in both directions. This NVIDIA situation represents something much bigger than just one company's risk management. We are watching the concentration of enormous economic power in the hands of a very small number of tech executives. Jensen Huang and Sam Altman can now conduct private negotiations that move hundreds of billions of dollars in market cap and reshape entire industries. Think about the implications. Two people in hurried phone calls making decisions that affect pension funds, retirement accounts, and savings of millions of ordinary investors. And they are doing it through complex financial structures that most professional analysts don't even understand, let alone retail investors. This is what happens in the late stages of any market cycles. Simple business models become complex web of interdependence. Everybody believes they have found a new paradigm that transcends traditional risk until it doesn't. Look, I'm not here to tell you that NVIDIA is going to zero, or that AI is a bubble, or that you should panic about your investment. But I'm here to tell you that the world's most valuable company has started to build a business model that's far more complex and risky than most people realize. That the metamorphosis is taking place. When a company becomes both the biggest supplier and a major customer in its own ecosystem, when billion-dollar deals get negotiated in last-minute phone calls, when major shareholders get 24-hour notice of game-changing partnership, that's not sustainable business strategy. That's financial engineering. And financial engineering always works perfectly until it doesn't. The house of cards might keep growing for months or even years. In bull markets, circular business models can create spectacular returns, but when the music stops, there won't be enough chairs for everyone. The question isn't whether NVIDIA's house of cards will eventually face challenges. The question is whether you will be prepared when it does. What do you think? Am I being too pessimistic about NVIDIA's strategy, or are we really looking at a house of cards waiting to fall? Let me know in the comment section below. And if this analysis was helpful, hit that like button and subscribe for more deep dives into stories that Wall Street doesn't want you to understand. I'll see you in the next one. Bye for now.